Hello and welcome with Trading with Technical Indicators. My name is James Boyd. Happy Monday to you. We got Barbara Armstrong in the chat. We welcome her. We'd like to welcome Luke, David, Riceberg, Ray, Elena, Dawn, Dom, and many others. Coming inside that almost 1 week to Christmas. Hopefully you might be buying some Christmas gifts, or I won't even attempt to go to the mall right now. I know the implied volatility is off the charts there. So hopefully you did your planning ahead of time before that volatility started to spike, if you know what I mean. Now, just real quick as we get started, remember that the information we talk about here today is provided for general informational purposes only. Also, remember that options carry a high level of risk, not suitable for all investors. We will show stock and option examples here today. Remember that also when we talk about examples, those will be done in the paper money software application known as the desktop version. Also remember that investing involves risk, including loss of principal. Now, today what I want to kind of talk about is some questions I received on diagonal setups, drawing the lines, seeing the setups, taking a stock or an option trade, but also I've had some questions on some bearish examples as well. So my goal here today is to try to kind of answer some of the questions that I received via X, or formerly known as Twitter. And let's kind of show you some examples of what you've been asking. We'll do stock and option examples. And from that, we're going to apply some trades here today. And they're going to be bullish and bearish examples because we've had questions on both. Now, just real quick as we get started, I want to kind of just show something just real quick, kind of where these markets are. So first off, and I know a lot of you like to do this, so I'm just going to quickly kind of take a quick look at where we are. NASDAQ here today, gap to the upside, and the intraday low was pretty much near the open today, and we're just smashing a new high. Now, I don't know how many highs that is. It's probably like 57, 58 new highs. Okay. Now, you would think that I would get that after 58 times in 1 year. Okay. But sometimes I don't get it. But more of the story is when you make a new high, it's just confirmation of an upward trend. Okay. Now, if you look at the DJX, talk about the tale of two tapes here. You see the Dow Jones below both moving averages, and we can't even fight our way up a paper bag and get above that 10-period moving average. We've been on the south side of that most of the time. Larger caps here kind of struggling, okay? And what hasn't been helpful that UNH has been down, among others, okay? Russell, and this is where it's kind of surprising because when you look at the NASDAQ and you look at the SPX and then you look at the Dow and you look at the RUT, you're thinking to yourself, how could they be so different? They can be, okay? They can be, okay? When you look at the smaller caps, not much strength, maybe trying to get a turn here, but when you look at the SPX, a little bit stronger. Now, if you take a look at the SPX, you're going to see that kind of the old high was right around, let's say, 60 and change, staying above that, and trying to get a little turn. What do we see on the S&P here today? A little green, Christmas tree green. Okay, it's never, might not hurt. And, you're going to see that the intraday low, where is it? It's right at the 10-period moving average. So when you kind of look at, let's say, the indexes, it's not even a comparison. And by the way, in the last 2 weeks or so, it's been like that. If you look at, let's say, the NASDAQ itself over the last couple of days, let's go back and just kind of verify what I'm saying. When we look at the relative strength over 5, 10, 21, 42, 63, you say, well, this is totally different. Every day it's different. No, that's not been true. You look at, there's no other index, zero, including the S&P 500, that have really been showing the strength of the NASDAQ. More of the story? It's called relative strength. And if you play relative strength, that's probably where you've been focusing. Now, what we don't like on this chart, can anyone tell us what we don't like on this chart? Well, what we don't like on this chart is that the second horse on the outside, okay, is really the VIX. And we've been seeing in the last 2 weeks a little strengthening move from the volatility index. Let's take a quick look what this looks like. And why are we going to talk about some bearish trades? Maybe, at least maybe two. Well, when we talk about the VIX, we've been in kind of crossover territory. That's not new. That happened on the 6th, 10 days ago. You're going to see that we stayed above the 20, and you're going to see that today we kind of fell down to the 10-period moving average and got a little bounce. So today we're going to show some examples of maybe 2 to 3 bearish trades. When does the investor like to do bearish trades? When the VIX is low and diverging. When the VIX is low, getting a crossover to the upside, and price is respecting by staying above the moving averages. Now wait, why does the investor do bearish trades? Well, because sometimes things might be pretty high in the markets generally, where there might be a greater chance for things to maybe drop. Now, that doesn't mean everything drops, but there might be some stocks at risk of falling down, okay? Now, I want to kind of show to you just real quick, and I know you're watching Bitcoin, okay? You probably went to your Sunday service, okay? A little fun there. You ran home, and you actually probably at 7 p.m. Eastern, you pull up your futures charts on Bitcoin. Okay, I don't know what you did, but maybe that's what you did. Now, Bitcoin actually hitting 107. I mean, where's the top? Okay, maybe it's not right here. You look at Ethereum also, 4,000 has kind of been that glass ceiling, so to say. Can it get above the 4,100? Keep an eye on this. This is a massive cup with not really much of a handle, but definitely a higher low on the right-hand side. If we talk about width of this cup, we're talking about $1,700, which gives a $5,800 price target, okay? Now, this also kind of goes back to risk-taking, okay? If people are kind of sometimes buying these assets, people might be willing to take risk and also have some different type of asset classes they want to be in or just areas. Let me kind of show you the tale of two tapes here. When you look at, let's say, discretionaries, hitting a new high. When you look at, for example, let's say the IXC, I believe, the communication, not a new high. That came Thursday. The technology, okay, not a new high, but looks very much just like the S&P. And then this is where it gets nuts, okay? And you're thinking, there's like a tale of two markets here. You look at energy, I mean, just completely crashing. Okay, I mean that's a pretty good drop. Okay, and I apologize for being dramatic, but that's down 10%, and that's down 10% when the market's up. When I say market, S&P. Okay, when you take a look at also basic materials, that's also pretty good crashing down. Not full blown 10%, but it's just gone straight down. Now that's not all. You look at industrials, it's gone one way to the downside as well. You take a look at financials, which are a little under pressure. You can see that. We also look at utilities, one-way traffic to the downside. And you look at real estate, also been one-way traffic to the downside. How could the market be so different? Okay. When you look at crypto, you think $1 million is the price target for Bitcoin. At least that's what people think. When you look at some of these other areas, they're not in bear markets, but they are short-term getting punished. And people are chasing to those areas that kind of have higher volatility, higher growth prospects, and so on. Okay? So clearly the focus has been on growth, 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 growth. Okay? Now, what I want to do is I want to bring up an example. And let's kind of start with just real quick. Let's go to Boeing for just a moment. Okay, now, about 2 weeks ago, we talked about diagonal. And the question that someone asked me, okay, is how do you draw the lines, okay? Now, you're going to notice that I'm starting with this because we had our diagram, okay, from previous here, and I can kind of just speak to it. When we draw a diagonal line, what we're really looking for is the lower highs. So when the price goes down, and then it comes back up. Price goes down, and then it comes back up. Price goes down, and then comes back up. So what we're trying to do is we're trying to circle where did it go up to? Where did it go up to? Where did it go up to? And then we're going to circle those spots, just like we did here, 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 here. Now, by the way, the $1 million question is, how far do you go back? I mean, I'd go back probably 3-4 months if you could. Now, there might be some shorter term, maybe it's only a month, okay? But I'd be looking probably the last couple of weeks, maybe 3 to 4 months, okay? And the goal is what we did here is we're just kind of connecting these spots. Now, this might be easy for me, okay, or Barb. But let's kind of say, you said, James, is there like lower highs for brand new people? I think you could say that. And what you're going to now notice is, let me kind of take everything off, okay? And by the way, this matters because if you can't see where the lower highs are, you're going to have zero confidence to trade the breakout because you don't know where the angle is of resistance that's created from lower highs. Now, if you go back to this chart, what I'm going to do is, all I did is I went to style, okay? If someone said to me, James, I have a tough time seeing really where the lower highs are. I think the one way you could solve it is go to Hawkinashi, okay? Now, you don't have to know what that means, okay? Now, what you're going to now notice is I'm just going to go to the chart, and I'm just going to kind of look at where do we have some green candles, and then where did we have red candles start, okay? Where did the green candles where we went up, and then where did the red candles start? Green candle for 1 day, and then sell back down, sell back down, sell back down. So it's wherever we had the red and green candles. Those could be really markers for lower highs. Now, when we go back and draw these just real quick, so how do I know where the lower highs are? Well, the lower highs are going to be a green and red candle. Well, what's the significance? The significance is the green candle is where the price went up, and the red candle is where we started to drop back down. Hence, the lower high. Now, when we draw the line just quickly, how do I know how to draw it? Well, you're going to kind of look and see which lines kind of get the most touches. So if I kind of said, do I draw the line like this? I get about 3 touches. If I draw the line like this, I get 4 touches. Okay? All right. Hopefully that answers that question. Now, I want to go back to just Boeing. Now, by the way, do we trade off Hawkinashi? We're not going to, but I think it's helpful in actually seeing where the lines are. Now, by the way, you could flip this and take the exact opposite. If you said, James, I just don't have confidence in seeing higher lows. Pretty simple. Circle the red and green candle, circle a red and green candle, and then circle a red and green candle. Step 2, draw a line touching as many of those points as possible. Ladies and gentlemen, those are your higher lows. Okay? All right. There you go. Just the opposite of what lower highs were. Now, what I want to do is in trade number 1 is I want to go back to style, Hawkinashi, candle. Now, what you're now going to kind of see is we kind of went down for 1 day, down, and then close above the high of the low day. Green little dot there. Green dot there. Green dot there. Green dot there. And green dot there. So those markers really represent, okay, potential higher lows. Now, what you're going to kind of notice is whenever we got the CAHOLDs, you're going to kind of see it's what I just said. Red and green candle side by side. 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 Now, we could probably also call this class Deck Your Halls. Now, why did we, for example, not have, why is this like 2 green candles? Well, this is the second candle. This is the first candle. Why is there 2 green candles? Simple. Because we didn't close above the high of the lowest, most recent red candle. It took 2 days to do that. And why did this also do the same? It's a simple answer. Because we did not close above the previous day's high, the lowest, most recent red candle, until day 2. Okay, there you go. Now, what you're now going to notice is we're going to actually take another trade on this. Now, by the way, when did the Boeing trades kind of start? Well, we went back on Boeing and we started taking some trades when we saw Boeing breaking the diagonal line. Okay? And since that diagonal line break, it's been a pretty good move to the upside. What is the current position on it right now? Not sure if that really matters, okay? But we're going to go there. The current position, okay? And tell me what I should do on this. Now, I'm going to tell you, you can know everything about indicators. But at some point, you got to know something about trend, support, resistance, and so on. And then it really comes down to the brass tacks where the rubber meets the road, strategy. Well, what you're now going to notice is we have a 155 short put and a long 150 put that is expiring in the next 4 days. We're sitting at 98%. So what we're going to do is we're going to take that position down, okay? Now, by the way, James, was that properly position size? Nope, could have done more, okay? The gains or losses could have been bigger. In this case, is a gain. If we properly position size, probably would have had about 4 times that, 5 times that. We're going to right click on this, create closing order, and we're going to rinse and repeat. By the way, who says that? Bill says that, okay? So as Bill says, rinse and repeat only if the technician thinks that trend might continue. Now we're going to buy it back. Now, just because I put my order in, we can't assume that it's going to get filled. We need to verify. Okay, so if I put that in, note the commission, send the order. So going to close that. And now what I'm going to do in this case is I'm going to go ahead and go back to, okay, we're going to go back down to the January. Can't even believe I just said January. Okay, that means cold, snow, ice, whole 9 yards. Okay, some of you are more excited than others. Now, if the investor said, James, I'm pretty bullish on Boeing. I think it might be underrepresented in some portfolio managers' portfolio, maybe rightly so. I'm going to maybe sell a closer strike to where we are now. So the stock is at 173. The strike we're looking at 510. We're going to right click on the 510, sell, and go right back to vertical. Okay. Now, if we're sitting in a situation where the VIX is low and maybe starting to go up, I think it might be kind of, for some investors, it might be appropriate to have defined risk trades. Okay. Now, what you're now going to see is if we properly position size this, easy math, let's say we could risk 1,000, confirm and send. How much is it per contract risk given a vertical? Well, it's about 323. Well, if we could do $1,000 worth of risk divided by 323, it's going to give us 3 contracts. We're going to come back, 3 contracts, credit, confirm, send. So if you said, what indicator are we really using that we've talked about the last 2 weeks? Diagonal, okay? And also close above the high of the low day. But also with that, identifying the CAHOLD dots also mark where these higher lows are by seeing the the red candle, green candle. The red candle is where we pull back to, and the green candle is where we start going up. I'll repeat that. The red candle is where we drop down to. The green candle is where we start to go back up. So you kind of think about it, it's almost like a V, right? Drop down in price, price starts going back up. Falling down in price, red candle, green candle, we start to see the price bounce, green candle, start to go back up. It's like a V, okay? That V, at the bottom of the V, that's your higher low, okay? Now, once it's in your head, you can't even shake it out. It just gets stuck. Now, notice on this position, this previous one did not fill yet. So I'm going to go back in, okay? Do not think, oh, yeah, I put my order in, it should fill. Don't ever say those words. It should fill, okay? I'm going to put it to about 5 cents. So one of the damaging things is if you wait all the way to expiration, the open interest starts to thin out, and getting a fairer fill or fill might become a little harder. Now, what you're now going to notice is in the Decembers we just got out, that did fill at the 155 and the 150. Just want to check something for just a moment. On the 155, just briefly, there was plenty of open interest, but we had to go up about 3 more cents to get it filled. Okay, now, second question that kind of came out here is something. Let's go back to something. Yeah, so a lot of those, let me bring this up. So right on my X page, right at the very top, what you're now going to notice is right at the very top, right here, these are the scripts we use in class, okay? Now, I want to kind of, speaking of some scripts there, so by the way, the scripts are what is in blue, okay? Each row represents a script, and the script is in blue. You cannot copy and paste that because it's not like a Word doc or something. Write the script down and just type it in. and it should pull up kind of like with what we have. Okay. Now remember, when we talk about scripts, not guaranteed for timing or accuracy, but they might be helpful, better than just doing things manually. Now, I want to kind of go back to the second trade example, and I want to go back to just real quick a good situation that's occurring. Okay, you got MU. Now, I want to talk about channels. Okay, now when we talk about channels, you're going to see that I'm going to show an example of a bullish channel. I'm going to show an example of a bearish channel. Now, what's the significance? And well, when we go back to, let's say, a bullish channel, we're talking about where the price is going back to the upside or trying to. And I'm going to kind of mark this here as well. Okay. So we got 3 touches at 113, just good old resistance. And what you're now going to notice is we kind of have a couple touches here about the 108. Today, the price gapping to the upside with earnings on this one on the 18th. Now, here's the deal, okay? If you really want to verify that, you can go to the company's website. Typically, with every public company's website, there's a tab called Investor Relations, okay? And if you click on Investor Relations, it will typically say confirmed for the earnings of the date of X, okay? That's if you really want to verify. Go back to the mother source, the company itself. Is the earnings date confirmed? And is there, maybe you could jump on the conference call, whatever, okay? And also see any things that they actually stated in maybe a PowerPoint form to let investors see. Good data, by the way. Now, if we take a look at this, you're going to see that we have a position on this, and we're getting lucky, okay? This position, when we talk about trading it based on probabilities and letting the probabilities play themselves out, this position was probably in the tank, probably $750. With today's upside move, got a little help here, okay? So now what you're going to see is this 110 put, it was down $750. Now it's down about $80. Now you might think we're just crazy, okay? We're going to take, in our example, we're going to take that $80 loss. Why are we going to take the $80 loss? Well, because we don't have much time left, okay? And I'm trying to get out where this is not a trade that really has a defined risk unless you call the price fall. I mean, unless you say that it has a defined risk, it can only go to 0. That's not the defined risk I'm talking about. I'm talking about something less than $11,000 worth of stock, okay? Now, what I'm going to do is I'm going to change the strategy here, okay? What we're going to do in this case is we're going to right-click on this, create closing order. We're going to buy that back. We're really saying in this case, I don't want to be short the option, okay? Let me actually just double-check something. A thought just came through my mind, okay? I just want to double-check how much are these. Yeah, they're, okay, forget it, okay? I was just checking to see how much are those puts below us. The answer? They're very high. Why are they high? It's because the implied volatility is only 144, okay? So I was thinking maybe we could buy a cheap put. 144 ain't going to get probably too many cheap puts. Now, we're going to buy it back, okay? Now, what we're going to do is we're going to change the strategy. Now, note the commission, send the order. Now, we would lose about $80 on that, but I think that's a win. If we go from being down $750 and being down $80, that's pretty good. We just ran out of time, okay? Now, I want to kind of take a look at this, okay? When we have a stock that's getting above resistance, that's a higher high, okay? Now, the thing you always want to remember is if we make a higher high, the highest likelihood, highest probability is to make a higher low, okay? Now, you might say, well, James, I want us to get above 113 to say that we made a higher high. Then I'll say that we could have a potential chance of making a higher low. Okay, fine. Have it your way. But right now for our class, we're going to say, look, if we're getting above 108, okay, maybe there's a good chance that we can make a higher low. Now, what I'm going to try to do is I'm going to try to sell the put in the pre-money count that's like at 105 or less. And we're going to try to use the volatility to set with that high volatility to try to get some decent premium. Okay. Now, by the way, is volatility an indicator? Is volatility an indicator? If I brought this up just real quick, I mean, is it? I'm not trying to do a little trick question to you. Okay. Now, what I'm going to do is I'm going to pull up MU right in the list. And I think that right on the top of the list, you're going to see that right there, IV% plus T. What was that? Maybe 6 weeks ago we went over that. The implied volatility percent is what we normally see on the trade tab, bottom left-hand side. Just tells us where's the current IV relative to where the low and high has been. So think of it like a percentile ranking, okay? Or ranking, what's the implied volatility now versus the lower high, okay? Now, what you're going to now notice is, what do we see on MU? Huh, my gosh, it's at the 85th percentile, okay? So what you're now going to notice is, and by the way, why is the background green? Simple answer. The background is green. It's using the moving average. Price is greater than the moving average. Price is up on the MACD and the stochastics for how long? I don't know. Let's double check. We're going to right click. We're going to edit formula. Now, this is the beautiful thing about these. If you have these, go to edit formula. And if I can just read, okay? And if I read this, it's going to say right at the top, dark green, prices above moving average, MACD, stochastics, more than 3 days. All right. So that's why it's doing that. And now if you said, well, James, I don't really know what's the number printed in the IV box, that is the IV percentile for the last year. All right. So now if I go back to this, what we're going to do in this case is we're going to take a bullish trade on MU. We're going to sell the 105 and we're going to buy the 100. Now you might be thinking, well, James, I'm a stock investor. Why would an investor do this versus, let's say, buying shares of stock? One major answer. Well, number one is, I mean, if you own stock and you set a stop, you have a trigger to sell, but it doesn't guarantee anything. Okay? You could gap down in that price way lower than where that stop is and have a bigger loss than you ever thought imaginable. Maybe the investor doesn't like that. It kind of did sound pretty tough, though. Now, I'm going to sell this at 105, thinking price could stay above, and we're going to set this, we're going to buy this back at 100. Now, we're going to assume that we don't have a class, okay? And what we're going to do is we're going to say, look, if we could maybe, we're going to go single order, first trigger is SEQ. We're going to have a buy back in place. Right-click on this line, create opposite order, okay? So let's kind of say, look, some people might say, James, if I could sell it for $2 and buy it back for $1 and keep the buck, that'd be pretty good. Some people might say, you know, James, I was kind of thinking about 65%. Okay. Well, if you sold it for $2, okay, and you were trying to make 65% of the premium pre-commission, well, it would really be that you're trying to keep $1.30. And then what's left? Well, 70 cents. Okay, $1.30, 70 cents equals $2. Or you could just flip it like this and say, look, I'm going to try to sell it for $2 and only have left 35% of that initial credit. It's going to get you to 70 cents. Either way will get you there. We're going to go dated GTC. Now, what does this mean? If MU maybe holds or gaps to the upside a little bit, this order could fill even though it's not in our class. I normally don't do this because I want to involve you in the teaching, but you're now going to see in this case, if the price, if we can get out for a net debit there of 70 cents or less, it could fill. Now, wonder if MU gaps up a lot and the debit is 20 cents. Could the gain be bigger than anticipated? That's true, okay? But we need to see where the fill is, okay? Now, one of the major reasons why we're doing this, and by the way, just because I showed it to you doesn't mean someone knows how to do it, okay? Why are we bringing up the MU example? Well, it's an example of a horizontal breakout. It is also an example of a CAHOLD that really came from Friday. We know we're going into the teeth of the earnings, okay? Know that. Because of that, we're actually changing this type of trade to a vertical, okay, trade. and that's why we changed that right there. Now, I'm going to imagine that we're not going to take a full position's worth of risk, but maybe only half, okay? So when I say that, if we did 2 contracts, the max loss given a vertical pre-commission is $600. So if we typically risk $1,000, $1,200 on any given trade, we'd be doing 4 contracts. But since this is going over earnings, and since it is deemed to be pretty volatile, plus or minus $12, we're not going to take a full position. Noted? Note the commission. If that's okay, we're going to send the order. Okay, now, let's kind of talk about maybe a bearish, trade. Can anyone think of a bearish trade? Oh, that's funny. There's probably a few. Now, there's been a stock recently called NVIDIA, small company. Oh, that's funny. Okay. But what you're now going to notice is it's kind of a stock where we kind of had this up and down price movement. Most of the ranges have been between about 134-ish, 143-ish. Okay. Now, what do we see on the chart now? So one of the things we kind of look for is maybe a stock that might be going, maybe breaking up inside an old channel like MU. But what happens if you get an example where maybe the stock is kind of like NVDA, where it's not, let's say, breaking up to the top channel like MU is, but maybe it's breaking through the bottom, okay? Now, how many of you think in our lifetime that we're going to see some bearish trades? Anybody? Okay. Now, by the way, look at some of these, okay? ConocoPhillips, okay? Just pretty destroyed. I mean, look at that right end. Could you imagine if you were long ConocoPhillips the last 10 days or so? It's been horrible, okay? You're thinking, well, Exxon's probably a whole lot better. What part of that do you like? You're probably thinking, well, Chevron's a great company. Which part of that did you like, okay? So here's the deal. Sometimes people don't just buy stocks. They sell them. They don't want to have exposure to this sector, the industry group, and they maybe think that stock is maybe just not the right one to be in relative to other ones. So in our example, we're going to kind of pick a stock that's had a lot of love from investors, okay? Now, what we're going to do is we're going to do a bearish trade. Now, Barbara actually teaches the class on getting started with options. When we think about, let's say, doing a bearish trade, you've got to have a strategy, okay? One of the first strategy to learn when you're playing bearish is maybe a short call vertical, okay? The second strategy, which is probability-based, not a huge credit, but a credit. The second trade that's not as much built on probability as much as the first strategy, short call vertical, is a long put vertical. Has a higher potential gain typically, also built in max loss, but the biggest actually thing is someone, if they're going to do a long put vertical, they really think their direction is probably more correct. And they want a higher potential upside, okay, compared to a short call vertical. Now, our idea is if we break through the bottom of the channel, more channel. Well, the idea is maybe it might try to go, let's say, from the bottom to the top. The range there is about $10. $10 to the downside is going to be about right here, okay? Now, the way it works with bearish trades is sometimes they just drop very quickly. Now, not always, okay? But a lot of times when stocks drop, they can drop quite quickly. And so the idea is they drop and they bounce back up. They make a lower low and then they come back up, okay? So the biggest thing what I want us to kind of practice on, and I'm going to tell you something. If I don't teach you how to play bearish, I feel like I'm only teaching you only to play offense. There's going to be a time when the market, okay, stocks in general, whatever, they come crashing down, okay? Now, I'm not a bear. I'm not a bear. I think if most people listen to me over 20 years, probably say James is a perma bull. There's just some times where prices fall, okay? And I want to kind of make sure that as a teacher, we show both sides, okay? Now, what I'm going to do is we're going to go to the trade tab. And what we're going to do is we're going to kind of say, look, we're going to sell a call. And if you sell a call, that's where you think the stock might not be able to get above that price level. Okay? Now, wonder if you're wrong here. If we actually see, for example, that if the stock, let's say, is 130, if the stock stays below 138, and let's say we wanted to, let's say, buy a call for, let's say, upside cap protection or a max loss, we're going to really sell the 138 and buy the 142. Now, if we do this, what I'm going to do in this case is I'm going to sell the 138 and I'm going to buy the 142. Now, here's the deal. You can widen that spread out. If you widen the spread out, you're going to be doing less contracts. Now, if you did that also as well, we can see what the credit is. Now, if you take a look at this, what you're now going to notice is we have a maximum profit there of $120 and a maximum loss. The one main reason why people don't like bearish trades, a lot of times they don't know about options. They might be thinking about short stock, which is extremely risky and has a lot of kind of risk associated with it. Second is, with this type of strategy, there's a built-in maximum loss. So if we thought it was going to go down, but then it goes up, it can only get so bad given a vertical, okay? Now, what you're going to now notice is the credit also lets the commission. That takes away from the credit overall, and we see the buying power is just really what the max loss is, okay? Now, what I'm going to do in this case is if we could risk, let's say, $1,000, we're going to go back and do, let's say, 3 of these. Can we? Well, if we did 3 of these, it's going to give us a maximum profit here, $360, max loss, $840. Now, I want you to imagine that you said, James, I have 12 or 15 positions in my portfolio. All of my positions are bullish. So what happens if the market comes down? Well, all my positions are bullish. People tend to like to maybe consider putting on 2, 3 bearish positions if the VIX is low and diverging. Okay. Why? Well, because if the market comes down, your stocks are highly correlated to the market, most likely. They come down, and at least you might have something, bearish trades, that might go up in value and might offset some. So the fallacy is, well, if I, for example, have some bullish trades, let's say 10 or 12 bullish trades, and I put on 3 bearish trades, does that mean I'm bearish? No. Okay. You really need to look at your overall delta of your portfolio, and that's going to tell you if you're really bearish. We put on 2 or 3 bearish trades, it ain't going to make our portfolio bearish. Okay. It's just going to make our portfolio less bearish. Okay. Now, if we take a look at this, we're going to go ahead and send this order. Now, the goal of this trade is to get the price to fall down to about 125. Now, what I'm going to go ahead and do is, if this trade will fill, I'm going to go ahead and set the price target. Okay. Now, I'm going to move the price down. Let's see if it fills. Now, when that order fills, hopefully, I'm going to come back in. And what I'm going to say, look, if we get down to a price level about 125 and change, okay, I want to get out. Okay. It hasn't filled yet. For our time's sake, we'll just move the order to, let's say, limit to a market. That way it can get filled. Now, what I'm going to do is I'm going to also, now, by the way, notice when we did market, we're down $22. Why did it do that? Well, because we didn't wait to get filled at the limit price. You still probably most likely be down a little bit, but when you didn't market, you didn't really get as maybe as good as fill. Okay. Now we're going to set a buyback. Okay. And when we set this buyback, what you're now going to notice is we're going to say limit, market, dated GTC. When we go to GTC, we're going to click on the gear. When we click on that gear, what I'm now going to do is go symbol, NVDA, mark, okay? If this confuses you, let's kind of talk about it. And what I'm going to do in this case is I'm going to put 125, and if you don't mind, I'm going to say 125 and a quarter, okay? So this confuses a lot of people. They're like, what does that even mean? Don't worry, type in the number, and then down below we can see what it says, okay? We can see what it, just read it. If the mark prices of a security is less or equal to 125.25, then exit that call vertical at its market price. Okay, so don't let that kind of make you fearful. Just go ahead and actually just come down to this right here. Now, if you take a look at this, I'm going to go ahead and go save, and I'm going to go ahead and say confirm and send. And now what you're going to see in this case is we got a commission there of $3.90. Note that. Now, what's the dangerous thing about bearish trades? What's the dangerous thing? Well, I'm going to go ahead and send this order. Note that. Send that position. And the dangerous thing about these type of trades is if you're going bearish, you need to keep an eye on where like a 30-period moving average is. You need to keep an eye on where the 50-period moving average is, because you might be going short right into major long-term potential support levels. Now, the moving average that I first put on, okay, was the let's kind of just put that up. Let me give a yellow there for that 50. Okay, so which one do we have? The blue line, that is your 30 simple moving average. We're below it. Okay, what's the yellow line? That is your 50-period moving average. If this trade was right at the 30 or the 50 or either one, putting a bearish trade on at that moving average, that would be pretty tough, because those might be longer term intermediate investors, like where they're trying to get in. We are below both of those moving averages. Okay, so that's something if you're going to do short trades or bearish trades, having those moving averages on the chart, those are critical. The only other moving average we might put on is maybe a 200-period moving average, and we got to keep an eye on that. Okay, I think that's, if we did the 200-period moving average, just to kind of keep an eye where those lines are. And we know that if we start going below the, let's say the 50, that could be an intermediate sign of weakness, sure. But the 200-period moving average is all the way down here at 115. Okay, so what's the significance? Well, we want to kind of know that there might be some room to drop down to those areas. The problem is if you start coming down to the 250, down to that longer term moving average, like that, let's bring it back up, that moving average, the 200-period moving average, that might be an area where some investors might exit the bearish position, and longer term investors, they try to get in. Okay, so a bearish entry is a broken support. A bearish entry might be at a level of resistance where you think that might not go up any further and then fall back down. Okay, the key is to this is you're not putting on bearish trades. Okay, you are going to put them on at resistance. You're trying to put them on maybe where the price is not able to stay up above the moving averages. The 30-period moving average, the 50-period moving average, you see it struggled there, and then it fell down through the floor. Now, what's one of the reasons why people don't go bearish? One of them, not all, okay? They think, well, NVIDIA is a great company. A lot of great companies fall, okay? Just like a lot of bad companies might go up. So the problem is if you kind of see things technically falling apart, how does the investor try to gain from that? Now, just quickly, a couple stocks to keep an eye on. We got to wrap it up here. One of the stocks that kind of had a channel is kind of break into the upside. Keep an eye on Visa. Think about all the processing fees going into Christmas time. My gosh. Okay. MasterCard is also there. Maybe not as strong as Visa, but Visa probably leads. If we also take a look at Apple, think about how many people may be trying to get an Apple device here. Okay. Tesla has been a rocket ship. Google, we talked about, is kind of gone through, kind of maybe finishing the cut pattern, had just a 2-day pullback and a big smash to the upside. The other one is Dash. We know that not everyone enjoys, okay, going out and seeing everyone. Okay, some people just say, look, just deliver it to my front door. Notice Dash is right at the 30-period moving average with a little CAHOLD dot. Keep an eye on that as well. Okay, now I'm out of my time here. Your homework assignment is I want you to practice these CAHOLD setups, channel setups, diagonal break setups, and then practice bull trades and bear trades. 2 bull trades, 2 bear trades. And that's where you start to really prove proficiency. Can you play in different trend directions? Okay. Now, also today we want to kind of really focus on kind of the bear case. And then sometimes they don't always go up, they drop down. The second reason why we bring that out of why that is so important is the better you understand about bearish trades, the more likely you are to be better at getting out of your stocks because you understand what a bearish entry looks like. Okay. So I think there's a dual meaning there. Now, remember, coming up next, we have Michael Fairborn coming up at the top of the hour. Thank you, Barbara Armstrong, for answering those questions in chat. Remember, our focus here today was CAHOLD, diagonal lines, and also channels, okay, showing bullish and bearish examples of that. Now, this class has been recorded. You can actually go right to the playlist. I'll put that in the chat here in just a moment. And also remember that you could actually follow myself and Barb on X, and that way you can see educational content and announcements. Thank you so much for your comments and your participation. Stay tuned for Michael Fairborn coming up next. Take care. Bye-bye.